Welcome to the deep dive. We take stacks of documents, cut through the noise, and really pull out the most important bits for you. Today we're diving into GAIL, India Limited, a huge player in natural gas. We've got their Q1 earnings for the fiscal year 2025-26, plus the outcome of their latest board meeting. These just dropped, dated July 28th, 2025, right before their earnings call. So you're getting a bit of a sneak peek here.
Exactly. Our goal is just to help you quickly make sense of what's crucial in these reports, understand the context, get those aha moments, without drowning in data. Think of it as your shortcut to really knowing what's going on with JL this past quarter.
Okay, so let's untack it all for you. Finances, operations strategy, even some potential roadblocks or challenges. Let's maybe start with the big picture then. Financially, how did GL actually do in Q1? What are the headlines?
Okay, so if you look just at the core operations, the standalone numbers, they reported a net profit after tax, PT, of 1,886 crore, and profit before tax, PBT, was 2,533 crore. Gross turnover came in at 34,735 crore. Pretty substantial.
Right, 1,886 crore PT standalone. And the consolidated figures. Those usually give a slightly wider view, don't they? Including the subsidiaries.
Yeah, exactly. And the consolidated numbers are a bit higher. PT was 2,369 crore, PBT or 3,029 crore. And the gross turnover there, 35,369 crore. So it does tell you that their broader investments in joint ventures are definitely contributing, adds to the overall picture.
It's interesting, just looking at the board meeting details. They spent over 4 hours on these results, 2 p.m. to past 6 p.m. What does that usually signal? Does that lengthy discussion suggest anything specific, maybe some complexity under the surface?
That's a good point. A long board meeting for earnings, it often means they're really digging into the details, not just rubber stamping. Could be debating market conditions, maybe some operational hiccups, or quite likely really hashing out future strategy and those big investment decisions. Shows they're quite hands-on.
Makes sense. Okay, moving on from the financials to, well, the actual business. The physical side, how were the volumes? What moves through their system?
Right, the physical performance. Things look pretty active. For Q1 FY26, petrochemical sales were 177 TMT, that's 1,000 metric tons. Liquid hydrocarbon sales, 198 TMT. LPG transmission was quite strong at 1,131 TMT. And then for natural gas, transmission was 121 MMSCMD, million standard cubic meters per day, and marketing was 105 MMSCMD.
So pretty steady operations across the board.
Yeah, generally looks like a healthy, consistent pace.
Okay, now this is where I think it gets really interesting for understanding their main business, the natural gas breakdown. Where's the gas coming from? And where's it actually going?
Yeah, this is key. So for transmission moving the gas, 71% comes from RLNG spot, that's the imported liquefied natural gas, regasified, often bought on the flexible spot market.
Right.
Then you've got 27% from APM and APM gas, which is more regulated pricing.
Yeah.
And a small slice, 2%, from RAL and BP's fields.
So heavily reliant on imported LNG then, over 70% on the transmission side.
Definitely. It highlights how much global LNG market swings can impact their supply and potentially their costs.
And for marketing, selling the gas, is the source mix similar?
Slightly different breakdown for marketing. It's 48% RLNG spot, 35% APM and APM, then 14% is actually overseas sales, perhaps trading, and 3% RIL and BP. Still a big chunk of RLNG.
Got it. And on the demand side, who are the big customers buying all this gas?
The mainstays are fertilizer companies and the city gas distributors, the CGDs. In Q1, fertilizers took 32% of the marketed gas. CGDs took 27%.
Okay, that seems pretty standard for India's gas market.
It is. But what's notable this quarter is the power sector. Its demand jumped from 7% in the previous quarter, Q4, up to 11% in Q1.
Oh, interesting. That's quite a jump. Any idea why?
Could be a few things. Maybe gas prices became more competitive against coal for power generation, or perhaps just higher electricity demand overall, needing more gas plants to run. It's a trend worth watching.
Definitely. Okay, so connecting this back to the financials, beyond profit, what's their overall balance sheet health look like, stability-wise?
Looking at the balance sheet as of June 30th, 2025, total assets were 1,017,397 crore.
Yeah.
Equity stood at 72,241 crore, and liabilities at 45,156 crore. Net worth clocked in at 65,127 crore. It paints a picture of, well, a pretty robust company financially.
Solid numbers. What does that equity versus liability tell you?
It means they have a strong equity base. They're not overly reliant on debt, which gives them flexibility, financial headroom for future plans or weathering any bumps.
Right. And the key ratios, things like debt to equity, EPS, how efficient are they looking?
Their debt-equity ratio for Q1 was 0.24. That's very healthy, quite conservative, especially for an infrastructure company that needs a lot of capital. Earnings per share, the EPS, on a standalone basis was 2.87.
Okay. And things like return on capital employed.
Yeah, return on capital employed and paid out to net worth ratio were both around 12%. They did dip slightly compared to the full year FY25.
That slight dip.
Yeah.
Concerning. Or just noise.
Not necessarily concerning on its own. It could just reflect heavy investment cycles. Spending big on projects that won't pay off immediately still shows decent ongoing profitability.
Okay. And how's the market taking on this? Share price, market cap.
The share price was 191 at the end of June 2025. That gave them a market cap of 1,025,486 crore.
So investors seem reasonably confident then.
Seems like it. The market cap reflects confidence in their operations, their financial health, and likely their future plans, despite maybe a slight dip in those return ratios for the quarter.
Speaking of future plans, let's talk about capital expenditure, or CapEx. Where are they putting their money? What does that tell us about their strategy?
Right, CapEx is always revealing. Their estimate for this fiscal year, FY26, is about 10,700 crore. That's a small increase from last year's 10,512 crore. But the really interesting part isn't the total amount, it's where the money is going. There's a big shift.
Oh, how so?
Well, last year, FY25, the biggest chunk, 44%, was labeled operational CapEx and others, sort of keeping the lights on and miscellaneous stuff. For this year, FY26, that category is projected to drop way down to just 18%.
Okay, so a massive drop in operational spending.
Yeah.
Where's that capital being shifted to? This must tie into that green push people talk about.
Exactly. That's where you see the strategy. Big jumps elsewhere. Petrochemicals CapEx is up to 28% from 25% last year. Pipeline projects up to 26% from 21%. They're investing heavily in core infra. But here's the headline grabber. Net zero renewables. Last year, it was just 1% of CapEx. This year, it's projected at 11%.
Wow, from 1% to 11%. That's a huge jump.
It is, and equity investments are also up from 6% to 13%. So it clearly signals they're doubling down on expanding their main pipelines and petrochemicals, but also making a very significant strategic pivot towards renewables and potentially new ventures or partnerships. It's not just talk.
That allocation shift is definitely a major signal. Now, no deep dive is complete without looking at, well, the potential issues or nuances. What did the auditors flag? Things that might not hit this quarter's profit, but could matter down the road.
You're right, there are always contingencies. A few key ones here. First, these PNGRB tariff disputes. The Petroleum and Natural Gas Regulatory Board sets tariffs for pipelines. GAIL is fighting several of these orders at the appellate tribunal. Some customers are fighting them too.
Why is that significant?
Because pipeline tariffs are a core part of their regulated income. If rulings go against them, it could really impact their future earnings from that business segment. It's a fundamental part of their revenue model under potential challenge. Then there's this NIFTY classification dispute. It's a long-running thing with central excise over how naphtha should be taxed. The demand is huge, 2,889 crore plus interest, making it about 3,674 crore now.
Whoa, that's a massive number. What's the status?
They've appealed to the Supreme Court. They got a stay, but had to deposit some cash and provide security. GAIL says based on legal advice, they expect to win and haven't set aside money for it, no provision made. But it's a big potential liability hanging out there.
A multi-thousand crore potential hit, even if they're confident. Risky. Anything else?
One more major one. The Nagarjuna fertilizers, NFCL dues. GAIL is owed about 840 crore by NFCL. Again, they're confident they'll get it back through expected government subsidies to NFCL, maybe policy changes on other claims, selling some NFCL assets. So again, no provision made, but recovery isn't guaranteed.
So it sounds like while the auditors didn't find any current loan defaults and that big private placement from 2022 was used properly, these disputes and recovery issues are like off-balance sheet risks investors need to track.
That's a good way to put it. Hidden risks, or maybe deferred risks. Management is expressing confidence, which is important.
But what's the real potential gotcha for investors if, say, that NAFTA case doesn't go their way?
Yeah.
Despite the confidence.
The gotcha is the sheer size. If they lost that NAFTA case, a sudden need to provision nearly 3,700 crore would hammer that year's profitability. It could shake investor sentiment, even if the underlying gas business is fine. Same, though smaller scale, if the NFCL money doesn't materialize, it impacts cash flow and financial flexibility.
Right. Definitely things to keep an eye on.
Yeah.
Okay, so wrapping this up, it seems like GL had a pretty solid, if complex, Q1 for FY26.
Yeah, I think so. We saw good operational performance in their core gas business,
Hmm.
a very clear strategic shift in spending towards growth pipelines, petchem, and notably a big push into renewables. And alongside that, managing these significant legal and financial contingencies with stated confidence.
So, thinking ahead, given these big shifts in spending, especially that jump towards net zero and renewables, and also considering these ongoing legal battles, what could JL look like in, say, 5 or 10 years? If these bets pay off and the legal issues resolve favorably, how might this Maharatna company, this government designated major enterprise, actually redefine itself within India's changing energy mix? Could it really move beyond just being seen as the gas pipeline company? What's your final thought on their transformation?